The largest company in the world has been going through tough times. It has over 800 million customers, but at the peak of its height, it was at $800 billion in market cap. Today, it is only at 450. But this could be a huge buying opportunity for long-term investors to get in at this lower price and then ride the wave up. Hello everyone, I am Colin and this is Harness Money. Thank you for being here. I love having you here. Go ahead right now, tap the like button, and I will show you a picture of my dog, Dexter. Alright, in this video, I'm going to cover everything about Alibaba. Alibaba is the Chinese e-commerce giant that has over 800 million users. They have over 500 billion in market cap, but they have been hit hard in the past, I would say, year for various reasons. So this could be a very big buying opportunity, or it might not be. Let's get into everything that I see going on with this company, and let's start with what happened to Alibaba that it declined from its highs of 800 billion down to 450 billion in market cap. And it really starts with Jack Ma. Alibaba was doing incredible. They were having great growth. They did their IPO. Users were growing. Revenue was growing. But then Jack Ma made some comments that the Chinese regulators were a little bit too aggressive in China, and that the regulation that Alibaba was receiving was stifling growth, stifling Chinese innovation. And that really caught the attention of the government, of the Chinese government. The Chinese government doesn't like when a business points the finger at the country or at the government. And so they started digging into Alibaba. They started looking into Jack Ma. He had to go into hiding. He's just resurfaced recently in Hong Kong, but he has really had to lay low and keep his head down and just do the work that he was meant to do in order to not cause any more waves for the business. But it all started with Jack Ma, but then it led into more. I believe that the president of China realized that these tech companies, these larger-than-life businesses with hundreds of millions of customers, were becoming a little bit too powerful, or maybe were threatening the power of the overall government, that they had so much information on the citizens of the country, that they were providing so many services that citizens of China were relying on these businesses more than they were relying on the government. So the government has done a crackdown. This has led to the entire Chinese stock market sector to decline, and it doesn't help that the overall real estate market has also now been hit, that the Evergrande and the Fantasia scandals that have come up have really depressed the just the climate, that the economic outlook for the country of China. It has dragged everything down. But Alibaba is at the center of it because they are the biggest. They are the big dog that is growing the most, that has the most users, and that is the most visible. So this has all led to a decline in stock price of Alibaba. What do I like about Alibaba? There is a lot to love about Alibaba. 800 million users. This year, they are going to surpass $800 billion in revenue with net income of more than $150 billion. That is massive. No other company is doing those numbers, but they're having to put a lot of that money back into the business. With the tech crackdown, the government stepped in and said, okay, you guys are going to have to upgrade your security features. You're going to have to do a lot more research and development to satisfy our regulations. So Alibaba is pouring all of that money back into developing that business, and it shows. The revenue expectations for this business are continuing to rise year after year. For the next 2 to 3 years, they expect 25% revenue growth. That is huge for a business that is already huge, and I really think that they're going to beat those expectations, that they are going to be like Apple or Google, and they are going to come in above what analysts are expecting. I think that is what will drive the share price back up higher than it ever was before. But we'll see. We'll have to wait and see what plays out. But the other thing that I like about Alibaba is that it has many different streams of revenue. This is kind of a plus and kind of a minus for them, because they have the e-commerce platform that has really driven the growth. Then they have, like Amazon, they have a cloud business, which is where they serve other businesses in China. Then they have a media and entertainment division of the business. Then they have the financial division, which they have really outsourced to their sister company, Ant Group, which had a scuttled IPO, but that is still a part of their ecosystem. But this works against them in the fact that really the Chinese government is looking at them as being too big. They've stepped into too many different areas of society, and the government wants them to sell off the media division. That would be their shows, games, music, all that type of entertainment they want them to sell off. But for now, it all gives them more revenue and more ways that they can monetize their service. What I don't like about Alibaba is the uncertainty. Wall Street, more than anything, hates uncertainty. This is another reason why the stock has gone down, because Wall Street doesn't know what the Chinese government is going to continue to do. They don't know the end game of the Chinese government. When the news hits, that is when Wall Street gets scared. But then when the actual action takes place, that gives them some certainty. So if they have to pay a fine, great, pay the fine, be done with it. It's just the lead up to what is going to happen, which causes investors to be scared and nervous. And nobody knows what the end goal of the Chinese government is going to be, and that is leading more and more people to be uncertain about the future of this stock. The other item is that the Chinese government owns everything in China. They own the people, they own the businesses. The government is eternal. So everything is owned by the Chinese government. It's not ownership structure. The ownership structure of Chinese businesses is different than a regular American US business. There are rules against foreign ownership. They don't want too many foreigners owning majority of the Chinese businesses. Same with America, General Motors, American Airlines, they don't want Chinese companies or people owning the majority share of an American business. But there is a way around offering your shares onto the US market so you get US investors. And this is what Alibaba has done through variable interest entities. They created a company set up in the Cayman Islands to own all of the profits of that business. The business in the Caymans is entitled to all of the profits that Alibaba makes. Then Alibaba, through this company that they have set up, offers ADRs, which are shares in America. They offer American depository receipts. So Americans are really buying into this Cayman Island business structure that has been set up rather than investing directly into Alibaba. So American investors aren't entitled to, let's say, the plant and property and equipment of Alibaba over in China. They're entitled to the earnings that are coming through this entity in the Cayman Islands. It's a different structure. It's just a way of getting investors from America into foreign stocks. But I believe that this business is currently growing and is going to continue to grow in the coming decades. That 20 years from now, it is going to be so much larger than it is today. That being said, I am not putting my own capital into this business right now, and that is because I believe that this stock is really expensive already. It's $400 billion, $500 billion valuation. That is really high. I like to think in terms of, am I going to double or triple or quadruple my money in the next 5 or 10 years? And I believe that if you put money into Alibaba, you will double your money, but it's going to be a long time. The overall Chinese economy climate is a little bit depressed right now, and that could linger for a little while. The other thing is the uncertainty around the government regulation. They haven't quite defined what that looks like or what that means for these tech stocks, and I think that's going to weigh on the share price. The other thing is that it's so much easier for a smaller growing company to double in share price, to triple in share price, to go from $20 to $40 to $80, rather than going from $200 a share to $400 a share to $800 a share. It's not impossible. It's definitely been done with companies like Mercado Libre or Shopify or Expedia, but with Alibaba, I think it's going to be a little bit longer term that it's going to take in order for this stock to double. But it's definitely at a depressed valuation. It's undervalued right now. So if you are a long-term investor, if you want solid stocks that are going to be around forever, this is going to be one of those stocks. I love that Charlie Munger has come out and said he is all in on Alibaba. That's Warren Buffett's right-hand man, and he usually invests in a little bit safer stocks. If you do invest in this, you are going to do well. You're going to increase your money over time. It's just, I don't know if this is the fastest way to double your money or triple your money in the short term. I think there's other better opportunities out there that I am looking into. Thank you for watching this video. I hope you learned something. I love chatting with you. Leave a comment down below. I respond to every single comment. And don't forget to hit the like button, and remember, make good money choices. Till next time.